Welcome to this explainer. When most people hear the phrase corporate finance, they instantly picture dry textbooks, incredibly rigid spreadsheets, and, well, just a whole lot of stressful math. But actually, scratch that. I want you to completely transform that view today. We're going to look past the numbers and demystify the actual engine room of a business. Because trust me, this isn't just about counting money. It's a dynamic, super high stakes system that literally keeps the entire organization alive and pushing forward. So, here is our game plan for today. We're going to start by exploring why finance is more than just money. Then we'll map out the broader finance ecosystem. After that, we'll meet the finance officer, break down their 3 critical make or break decisions, and finally wrap things up with the ultimate balancing act. All right, let's jump right into section 1, more than just money. What is finance, really? I want you to honestly reflect on this for a second. What immediately pops into your head when you hear the word finance? For most of us, it's just money, right? We think of currency, banking, or maybe watching the stock market ticker. And sure, while the dictionary might define it strictly as the management of money and credit, viewing finance solely as a rigid set of numbers is actually incredibly limiting. It completely misses the heartbeat of what's really happening inside a business. What's really fascinating here is framing finance not as this one single boring discipline, but as a duality. On one side, yeah, you absolutely have the science. Finance is strictly governed by factual truths. Decisions have to be made based on financial statements that give you reliable, hard data about how a company is performing. You can't just make up whimsical figures out of nowhere. But on the flip side, we have the art. A business environment is never static, it's constantly shifting. Because of this, finance has to adapt. Experts are always bringing in new theories, like risk return or capital structure theory, just to navigate these crazy evolving markets. So, surviving really requires a highly creative application of economic principles. Moving right along to section 2, let's zoom out a bit and look at the finance ecosystem so we can establish exactly where business finance lives in the broader economy. If we map out the entire hierarchy of the financial world, it basically splits into 2 massive branches at the very top. You've got public finance, which deals with government spending and taxation, and then you have private finance. Now, under private finance, it splits again into personal finance, which is how you and I manage our own households, and business finance. Thinking about it this way really helps us precisely locate our focus for today. We're looking right smack in the center of the private sector, specifically at how organizations manage their survival. So, let's clearly define our core subject here. Business finance is the handling and management of the financial resources of a business organization, and it focuses on 3 major divisions. First, financial management. That's deciding what assets to acquire and how you're going to pay for them. Then there are capital markets, which involve studying the institutions that lend funds and, of course, the cost of borrowing those funds. And finally, financial investments, which looks at the value of stocks, bonds, and portfolio analysis. Basically, it's the whole shebang of acquiring, managing, and utilizing resources effectively. Now let's dive into section 3, meet the finance officer. This is the human protagonist at the very center of this whole corporate machine. I absolutely love this powerful metaphor from the source material. The finance officer is literally called the shock absorber of the company. I mean, think about what that implies for a second. You've got the marketing department demanding massive funds for some flashy new ad campaign. Then you have the production division asking to stockpile raw materials. And naturally, both departments believe their needs are the absolute most important thing in the world. The finance officer has to step in as this wary financial traffic controller, absorbing all these competing desires, balancing them against the company's actual cash flow, and making the really tough calls on who gets what. They absorb all that friction so the corporate vehicle doesn't just shake itself apart. And to really understand their power, just think about where they sit in the corporate hierarchy. Right under the chief executive officer, or the president, you typically have two major pillars. On one side, the chief operating officer handles production, marketing, and HR, basically the people making and selling the product. But on the exact opposite side, totally parallel in authority, sits the chief finance officer, managing accounting and the treasury. They act as the ultimate check and balance to the operating side of the house. Which brings us to Section 4, 3 critical financial decisions. This is where we break down the actual day-to-day mechanics of the finance officer's job. The chief finance officer isn't just sitting around staring at spreadsheets all day. They're actually executing what we can call the big 3 decisions: operating decisions, investing decisions, and financing decisions. These 3 categories form the complete blueprint for a company's survival and growth. Let's break them down one by one, shall we? First up, we have operating decisions. This is the foundational daily grind that keeps the business's lights on and the cash flowing. We're talking routine activities, providing immediate financial solutions for manufacturing, marketing, and purchasing. It means evaluating expenses against the budget, monitoring past due accounts, and just making sure there is enough cash in the vault to pay the bills without getting slammed with penalties. Now, even though these decisions are routine and might not require deep, complex economic analysis every single day, the finance officer still has to exercise incredible prudence and really wise judgment here. Next, we escalate the stakes a bit with financing decisions. Because let's face it, often the internal funds generated by daily operations just aren't enough to cover what the business needs, especially if it wants to grow. That's when the finance officer has to look outward. Financing decisions deal with raising funds from outside sources, like investors or lenders. The officer has to answer some absolutely critical questions. How much do we borrow? Do we seek short-term loans or lock ourselves into long-term debt? And most importantly, what is the expected cost of borrowing, the interest rate, and is it actually worth the risk? And finally, we reach the absolute peak of the tension: investing decisions. These are the make or break choices for long-term survival. This involves choosing between small and massive projects when new investment opportunities pop up. The finance officer must critically evaluate the expected return on investment and forecast the expected cash flows for several periods into the future. It requires some really substantial mathematical computations to get right, and the stakes, they are incredibly high. While an operational error might cost you a little money, an erroneous investment decision can literally lead to the downfall of the entire business. To really put that into perspective, let's talk about the sheer scale of these investment decisions. Our sources highlight a fantastic example: the decision to construct a power plant. We aren't talking about buying a few new laptops for the office here. A power plant involves an amount of not less than 20 billion Philippine pesos. Or think about pharmaceutical companies. They spend billions just on the research and development of a single new product before they even know if it works. Imagine being the person who has to sign off on that level of risk, trusting that your computations are spot on. No pressure, right? And that perfectly sets up our final section, the ultimate balancing act. Let's summarize the rigorous, almost superhuman demands placed on anyone stepping into this critical role. Stepping into these shoes requires mastering a whole matrix of qualifications. It proves it takes way more than just being good at math. In accounting and economics, they have to read financial statements perfectly, while simultaneously understanding how national inflation and interest rates are going to hit their business. In cross-functional operations, they don't get to operate in a vacuum. They must understand marketing, IT, and HR, because every single decision in those departments affects the company's cash. They need stellar professional relationships to keep the banks happy and willing to lend. And perhaps most crucially, ethics. They are handling highly delicate financial resources that literally dictate the livelihoods of all the employees. They absolutely must be morally upright and socially responsible. As we wrap up this explainer, I want to leave you with a bit of a provocative thought. We've just explored the massive, high-stakes engine room of corporate finance, the operating, financing, and investing decisions that keep billions of dollars flowing safely. But think about your own life for a minute. How do your own personal finance decisions mirror the complex mechanics of this corporate engine room? When you budget for groceries, when you take out a car loan, or when you decide to put money into a retirement account, you are effectively acting as your own chief finance officer. You are balancing the hard science of your bank statements with the evolving art of your own life. Keep that in mind, and suddenly, the big, intimidating world of business finance doesn't seem so distant after all. Thanks for exploring this with me today, and keep learning.